Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your teacher and your mentor. Today, we are going to cover IAS 21, the effect of changes in foreign exchange rates. Now, let's understand the concept of IAS 21. In IAS 21, exchange differences arise when there is a change in the exchange rate between the functional currency, which we are going to understand during this session, and a foreign currency, which we are going to understand as well, between the two different dates. Now, for example, a company wants to purchase goods from supplier. The functional currency of the company is leons, and the functional currency of the supplier is dollar. So now we have two different currencies, the functional currency of the company, which is leons, and the functional currency of the supplier, which is the foreign currency, is dollar. So now, if we want to settle that particular transaction, if we want to make payment to the supplier, it means we need to secure the dollar. We need to make payment in dollar. So for us to make payment in dollar, we need to convert our loans, our functional currency, to dollar at a specific rate. So now, if there is a changes in the rate, it means there will be impact on the exchange rate. There will be impact on the payment that we are going to make to the supplier. But also we need to know very important concept. If we are going to settle the transaction on the same date, then it means there will be no effect of foreign currency. There will be no effect of any changes in the foreign exchange rate. For instance, if the transaction date is today and we are going to make the payment today. Now, let's assume we want to purchase goods online, Amazon. When I place the order, I'm going to make the payment instantly. So in that situation, whether I'm going to make payment in dollar, in euro, or in pound, then it means I am not going to have any effect on the changes in foreign exchange rate because I am going to make the payment instantly. But let's assume I'm going to make the payment in a week time or a month's time. So it is possible that the rate at the date of transaction might change. It is possible that the rate at the date of transaction might not be the same at the date of settlement. So the difference between the rate from the date of transaction to the date of settlement might result to the possible changes in the foreign exchange rate. In other words, it might result for the company to pay excess, or it might result for the company to pay less. So that effect, that impact as to whether we are going to pay more to our suppliers or whether we are going to pay less to our supplier is what IAS 21 is talking about. So very important concept that you need to understand. Also, we are going to look at the precipitating factor, the basis, the reasons why we might have the changes in foreign exchange rate. One of the reasons is the fluctuation in the foreign exchange rate between the date a transaction occurred and the date it is settled or reported. As I mentioned earlier, if there is a difference between the transaction date and that of the date, the settlement date or the reporting date, then we might have the effect on the foreign exchange rate. Because if the transaction rate, for instance, if I'm going to pay, I have to pay $1,000 to a supplier. Now, if I'm going to make the payment today, which is the transaction date, the interest rate, let's assume, is 20 leons per dollar. So I'm going to make a payment of 20,000 leons for the $1,000 payment. But now let's assume I'm going to make this payment in 2 or 3 months' time from now. So it means in 2 or 3 months' time, the 20 leons per dollar might change. It might be 22 per dollar, or it might be 19 per dollar, whichever rate it might. So now that difference between the exchange rate at the transaction date, which is 20, and the exchange rate at the settlement date or the reporting date, which is 22 or 19, is what we are going to treat under IAS 21. So the first reason why we are going to implement IAS 21 is when there is a changes in the exchange rate between the transaction date and the settlement date. Another reason is the difference between the spot rate on the transaction date and the closing rate at the reporting date. When we are going to look at it further, we have different category of item that we are going to retranslate at the reporting date. And we have separate category of asset that we are not going to retranslate at the reporting date. Also, another reason is when monetary items like receivables, payables, loans, and cash are retranslated at the closing rate. We are going to understand the distinction between the spot rate, the historic rate, and the closing rate in later parts of the session. Then also, we are going to look at when translating foreign subsidiaries into the parent company presentation currency. For the financial reporting examination, we are not going to do the foreign subsidiary unless when we are going to look at the strategic business reporting, and also when we are going to look at the advanced financial management, the international investment appraisal. This is the time we are going to understand how we can translate from the group between the group structure between the parent and the subsidiary. So IAS 21 provides guidance on how to account for foreign currency transactions. Very important. When there is a foreign currency transaction, IAS 21 gives the insight, the guidance on how we can account, on how we can treat the exchange, gain or loss if there's any, or how we can account, how we can retranslate any monetary, items, and also how we can account for the non-monetary items. So basically, we need to understand the objective of IAS 21. And the objective of IAS 21 is to produce rules that an entity should follow in the translation of foreign currency activities. It is only individual transactions in foreign currency that are examinable in financial reporting. So we are not going to look at the group structure for IAS 21 under financial reporting. So now let's understand key definitions, which is very much important for us to be guided throughout the session. And then we are going to look at the different type of exchange rate that we have. First, we have the historic rate, the rate in place at the date the transaction takes place. For example, if I'm going to purchase an item to supplier, on that date, the exchange rate is what we refer to as the historic rate. Sometimes it is referred to as the spot rate, but it might be different. For instance, if I'm going to, if I'm going to purchase item from supplier today, let's assume, based on my previous example, the rate is 20 leons per dollar. This is a historic rate. Now, if I'm going to settle the transaction in 1 month's time, not at the reporting date, but in 1 month's time, then it means the rate at that 1 month's time will be the spot rate. So it might be the historic rate or it might be the spot rate. But now the distinction is that if we are going to settle the transaction, any period before the reporting date, then it means that rate that we are going to settle before the reporting date is what we refer to as the spot rate. Whilst the rate at the transaction date is what we refer to as the historic rate. Also, we are going to look at the closing rate at the reporting date. For instance, when we are going to look at the monetary items, when we are going to translate at the reporting date, we are going to use the closing rate to retranslate all monetary items. Also, we are going to look at the average rate. Average rate, these are rates throughout the accounting period, which we can use. When we are going to solve questions, we can able to understand when and how we are going to use the spot rate, the closing rate, as well as the average rate. Also, we need to understand the definition between assets and liability. When you're talking about the monetary items, items that can be easily converted into cash, they are short of a liquid cash. For instance, we are talking about receivables. We have, the right to receive payment from our customers. If we don't receive the payment, then we can take a legal action. Payables, we have the right, we have the obligation to make payment to our suppliers. Loans, we have the obligation to make payment to our loan providers. So these categories can be classified as the monetary items because they can be easily converted into cash. So when we are talking about the non-monetary items, these are items that give no right to receive or deliver cash. For example, we are talking about inventory, we are talking about plant and machinery. For inventory, we don't have the right or we don't have the obligation to receive or to liquidate any economic resources. If we sell the item, the inventory, then it's fine. If at the end of the period we did not sell the inventory, then it means we don't have any right to receive any cash, or make payment on behalf of the inventory. Also for plant and equipment. So these are a few examples of the non-monetary items. So it is very important for us to understand the distinction between the monetary items and the non-monetary items because the accounting treatment according to IAS 21 is not the same. Key concept that we need to know, we need to understand what is functional currency, especially for strategic business reporting students, because mostly when IAS 21 is tested, the concept for you as a student to able to identify whether the company, which currency of the company should be the functional currency or the presentation currency. So when we are talking about the functional currency, it's the currency of the primary economic environment in which an entity operates. This will usually be the currency in which the majority of the entity transactions take place. IES 21 says that an entity should consider the following primary factors when determining its functional currency. So for us to, to say that this is the functional currency of company A, or this is the functional currency of company B, or this is the presentation currency of company A, these are the factors we need to consider. First and foremost, if the currency is mainly used, it is influenced by the sales price. If we are going to, most of our sales transaction is done in leons, then it means that the leons can be our functional currency. This is an indication. If most of our sales, transaction is done in dollar, then it means our functional currency might be a dollar. This is one factor. Another factor we need to consider is the currency of the country whose competitive forces and regulations mainly determine the sales price of the goods and service. So for instance, if we are operating in the mining industry, we know that the mineral most mining companies are producing, the price is mainly regulated. It is on the stock market that the price for one gold, or diamond, or silver, or rutile is $10,000, for example, or $10, or £10. So now, if this is the case, then we can consider that particular situation to be an indicator for us to determine that the dollar, will be our functional currency. Another important point is the currency that mainly influence the labor, the material, and other costs of providing goods and services. So if majority of our cost of running the day-to-day operational activity of the business, majority, of our capital expenditure, is based on other currency, for instance, dollar or pound, then this is an indicator that, our functional currency is the dollar or the pound. Another factor is that if the currency in which funds from financing activities are generated, if mostly, we used to secure out loan in dollar or in pound, significant loan, which in most often the frequency we are receiving the fund from our financing activities, then we can consider that particular currency to be our functional currency. Also, if the currency in which receipts from operating activities are retained, it also can be an indicator for us to identify our functional currency. Now we are going to look at the factor for the subsidiary, when we are going to look at the advanced financial management as well as the strategic business reporting, that is how we are going to understand this particular aspect. Whether they operate independently, whether cash flow directly affect the parent. So this is the two factors that we are going to use to determine the functional currency within a group structure. So now we are going to look at presentation currency, which is different from the functional currency, though it might be the same with the functional currency, but the concept is not the same. The currency in which the financial statements are presented. If we are going to present our financial statement in dollar, it means the financial statement, it means the presentation currency is dollar. If we are going to present our financial statement in news, and if we are generating most of our revenue in dollar, it means our functional currency will be dollar, while the presentation currency will be the leons. So this is a distinction. The presentation currency is how we can present, which currency we are going to use to present, to prepare our financial statement. So now, what is foreign currency? Any currency other than the functional currency is a foreign currency. For instance, if the common currency is leons, then any other currency, with exception to leons, is a functional currency, might precipitate the effects of changes in foreign exchange rate, might give rise to the IAS 21. So if a business, go into transaction, if a business go into transaction with other currency other than the functional currency, then it might result to the effect of changes in foreign exchange rates. It will not 100%, it might. It can only result to the IAS 21 if there is a significant period between the transaction date and the settlement date. Then it is obviously that we are going to get some impact, whether we are going to pay more, or whether we are going to receive more, or whether we are going to pay less, or whether we are going to receive less. So also we need to know what is closing rate, the spot exchange rate at the reporting date. And also we need to know what is spot rate, the exchange rate for immediate delivery. So now, let's look at how we can account for individual company, as the group structure is out of the scope of financial reporting. So now we can go through the individual company, how we can understand the concept of IAS 21, how we can account for transaction within, an individual company. Now, in an initial transaction, on the date of transaction, if I want to purchase item from Amazon today, I place my order, I make my payment today, then it means the initial transaction date is today, the settlement date is today. Finish. There is no impact of the changes in exchange rate. There will be no implementation of IAS 21. But if there is a distinction, if there is a delay between the payment date and the transaction date, then we can account for IAS 21. So for the initial transaction, translate using, this is the concept that you need to know. For initial transaction, on the date of transaction, we need to translate using the historic rate. We are going to translate using the rate on the date of transaction. Also, the average rate can also be used if it does not fluctuate significantly during the accounting period. We are going to determine when we are going to use the average rate and when we are not going to use the average rate. But for financial reporting, we need to keep it simple. When we are going to look at strategic business reporting, and advanced financial management, this is the time where, mostly we are going to use the average rate. So now, this is the initial transaction. On the date of transaction, this is what we are going to do. We are going to translate, the currency using the historic rate. For instance, if I want to purchase a goods from my supplier, it means on the date the rate today, which is, for my example, which is $20, 20 leons per dollar, then we are going to translate the $1,000 we are going to pay, that we're supposed to pay to the supplier using the rate of 20. So it means today we are going to record a transaction of 20 million leons to the supplier. So we are going to debit the purchase by 20 million, then we are going to credit supplier by 20 million. So this is the transaction. This is the initial transaction. This is how we are going to recognize it. When we are going to solve question, we can understand better. Also, we are going to look at the settled transaction. If the transaction is settled, payment or receipt occurs during the accounting period. Now, we are looking at when we receive the payment or when we are going to make payments, if it is within the accounting period. For instance, if the accounting period is from the 1st of January 20X and the reporting period is 31st of January, then any transaction, any foreign currency transaction that took place in between the dates and it is settled in between the date, then this is what we refer to as a settled transaction. So now what are we going to do? Translate at the date of payment or receipt using the historic prevailing rate at that date. So firstly, we need to ensure that the date of transaction, we do our double entry. For instance, if we want to purchase a good from our suppliers on the date of transaction, we need to translate the $1,000 to leons, which we are going to debit the purchase and we are going to credit the supplier of 20,000 leons. So now, if the payment is to be made in 2 or 3 months' time before the reporting period, then it means we need to retranslate the payment, the actual payment that we are going to make. So as this may be different to the initial transaction, any exchange difference may arise. This is posted to the statement of profit and loss. So now let's look at the example so we can able to understand better. Now this is the example. We can solve this example so we can able to understand solution. Right? On 1st April 20X8, Milaco, a company that uses the dollar as its functional currency. So the functional currency of Mila is dollar. Buys goods from an overseas supplier who uses KR Chromit as its functional currency. So automatically, this has resulted to the foreign exchange risks. The goods are priced at 54,000 KR and payment is made 2 months later on the 31st May 20X8. So the transaction date is on 1st April. Let me state the transaction date. Transaction date equals to the 1st April 20X8 and the settlement date, the settlement date is on the 31st May 20X8. Very good. So now we need to ask ourselves whether there is a foreign exchange risk in this question. Yes, because our functional currency is not the same with the functional currency of the supplier. Our functional currency is dollar, and the functional currency of the supplier is Chromit, which is the KR. Then also, we are going to settle the transaction on a different date. The transaction date is on 1st April 20X8 and the settlement date is the 31st of May 20X8. So now we need to look at the exchange rate. The exchange rate on the 1st of April 20X8 is 1.8 per $1, and for 31st May 20X8 is 1.75 per $1. So there is a difference between the exchange rate 1.80 and 1.75. So automatically, this will result to a significant impact in the payment that we are going to make. It is possible that we are going to make more payment, or it is possible that we are going to make less payment. So now let's understand the transaction. So at the transaction date, this is what we are going to do at the transaction date. This is what we are going to do, right? We are going to convert the payment into our functional currency. So we are going to convert it. So the convert payment into functional currency, which is dollar. So now this will be the conversion. We are going to pay KR of 54,000 divide by KR. When we are going to look at advanced financial management, we are going to look at the concept of how we can, when to divide and when to multiply. But basically, we are going to look at the base currency and as well as the functional currency. For now, let's keep it simple. I don't want to make things so difficult. Let's keep it simple, right? The rate is 1.80. So now, let's use our calculator. 54,000 divided by 1.8 will give us dollar of 30,000. So this 30,000, we are going to, the double entry, the journal will be, we are going to debit, since we are going to purchase, we are going to debit purchase by 30,000 and we are going to credit our payables by the same amount. This is what we are going to do at the transaction date. Now, we did not make actual payment yet. This is just the accounting treatment. So now, at the reporting date, at 31st May settlement date, which is the 31st of May 2008, what are we going to do at the settlement day? Because this is the point in time that we are going to determine whether there is impact on the foreign exchange changes. So now, on the settlement date, we need to convert the same amount into the settlement, the spot rate. So now we are going to convert the payment using the spot rate. So now the 54 KR divided by KR 1.75. So this will give us a dollar of 54,000 divided by 1.75 will give us 3857. So now let's understand the concept. If the transaction was settled on the transaction date, it means we are going to pay $30,000 for this particular purchase. But now, if we are going to settle the transaction in 2 months' time, we are going to pay $30,857. So now, the difference between what we're supposed to pay and what actually we are going to pay is the exchange difference. So now, the exchange loss or difference is equals to the 30,000 minus the 3857. So therefore, we have an exchange difference of 857. So this is the concept and this is what you need to know. So now the double entry will be the double entry, the journal. We are going to, since we have credited our payables, we are going to debit the payables to offset the amount debit payables by 30,000, so we can zeroize it. Then also we are going to credit the manner in which we are going to do the payment. We are going to do the payment in cash because this is a settlement date. So we are going to credit cash or bank. So we are going to credit cash or bank with 30,857 because this is the actual amount we are going to pay. So for the particular amount of 500 and of 54,000. Then therefore the difference between the debit and the credit, which is a debit, we are going to show it as an expenses, profit or loss. We are going to show it in the profit or loss, which is the 857. So basically, this is what we are going to do. And this is the concept that you need to understand. So now we are going to look at unsettled transaction. For the first instance, the transaction is settled before the end of the reporting period, which is the 31st of May 2028. That is that is in between the reporting period. But now we are going to look at the point in time if we are going to settle the transaction, if the transaction is not going to settle at the reporting date, what are we going to do? How are we going to retranslate that particular transaction? This is the unsettled transaction. If a transaction is still unsettled at the reporting date, let's assume the reporting date is the 31st of December 20x8, then we are going to settle the transaction in, let's say, in February, 20x9, then it means at the reporting date, we need to retranslate. We need to do some retranslation for the monetary transaction only. We are not going to retranslate the non-monetary transaction, provided if it is valued at fair value. But we are going to look at it. Don't worry about it. There will be an outstanding asset or liability on the statement of financial position that we are going to retranslate. If we have an outstanding balance, whether it is an asset or liability, we are going to retranslate it at the reporting date. If the asset or liability is a monetary, this is a concept that you need to know. Let me highlight it for you. If the um, if the asset or liability is a monetary item, it should be translated at the closing rate. Key point: if the asset or liability is a monetary asset, it means we are going to retranslate it using the closing rate. If the asset or liability is a non-monetary item, it should remain at the historic rate. We are not going to retranslate non-monetary item. We are going to maintain it at the historic rate, the rate at the date of the transaction. Second point you need to know. Third point, the exchange differences will arise on the retranslation of the monetary items, and these are also posted to the statement of profit or loss. This is the journal. This is the treatment that we are going to do. So now let's solve example 2 so we can understand better. On 1st January 20XE, WCO, a company that uses the dollar as its functional currency, the functional currency of the company is dollar, buys goods from overseas supplier who uses dinar as its functional currency. So now this is a foreign exchange transaction because the functional currency of the company, WCO, is not the same with the functional currency of the supplier, which is dirham. So we need to account for the possible effect of the changes in the foreign exchange rate. The goods are priced at 35,000 dirham. This is what we are going to pay for the goods, 35,000 dirham. But our currency is dollar, so we need to retranslate our dollar to dirham. The payment is still outstanding at the reporting date of 31st March 20x8. So now it means the reporting date is 31st March 20x6. So it means the financial period for W code is from the 1st of April 20x5 to the 31st of March 20x6 for this particular period. On annual basis is the 1st of April, to the 31st of March, depending on the year. But for this particular example, the accounting period is the 1st of April 20x5 to the 31st of March 20x6. So now, if there is an outstanding foreign currency transaction at the 31st of March, then it means we need to know the nature of the transaction. We need to understand if the transaction is a monetary transaction, then we need to be in the position to retranslate the transaction using the closing rate. If the transaction is a non-monetary transaction, then we don't need to retranslate. We need to, we need to ensure that the transaction is not retranslated. We need to maintain the transaction at the historic rate. So now, the transaction is still outstanding at the reporting date. But let's do the journal first. At the transaction date, let's understand what should have been done at the transaction date. Right? At the transaction date, we need to ensure that we record the transaction. We need to debit the purchase and we need to credit the payables. So we can debit the purchase using the conversion rate. Now, the prevailing exchange rates are 1st January 20x6, 1.75 dirham to $1 and 1.9 dirham to $1. So now if we are going to do the translation on, if we are going to translate the transaction on the at the transaction date, then it means the amount of 35,000 dirham, 35,000 dirham, we are going to divide it by dirham of 1.75. So now 35,000 dirham divide 35,000 dirham divide by 1.75. So it means we are going to do an adjustment of $20,000, which equivalent to the 35,000 dirham on the transaction date. So $20,000. Now, another point we need to know, the transaction is not settled between within the accounting period, because this question stated that payment is still outstanding at the reporting date. So it means we still have a payables of $20,000 that is stated in our financial statement. So this payable also we have a purchase of $20,000 that is shown in our financial statement. But now the payable is among the category of the monetary assets. So now the monetary item, sorry. So now what we are going to do, we don't need to leave this $20,000 at the reporting date with this same value, because it might be possible that the value has changed, whether it has increased or whether the value has decreased, depending on the exchange rate at the reporting date. So the concept is telling us that if there is an outstanding asset or liability at the reporting date, if there is an outstanding asset or liability at the reporting date, it means we need to segregate between the monetary items and the non-monetary item. In this situation, the monetary item is the payable. So now we need to retranslate the payable. So at the reporting date, we need to retranslate. We need to retranslate. So now the reporting date, the payables we retranslate will be, right? The amount we are supposed to pay is $35,000, 35,000 dirham, sorry, 35,000 dirham. divided by the rate at the reporting date, which is the 31st March 2086, one dirham of 1.90. So now 35,000 dirham divided by 1.90. So the amount is in dollar is 18,421. So this is the amount. So it means the receivable balance has decreased significantly due to the changes in the exchange rate. So now if we are going to settle a transaction at this point in time, it means we are going to pay less. Instead of, to make a payment of 20,000, we are going to make a payment of 18,000. So now we need to account for the decrease in the payables balance. So now the difference will be the decrease in the payables balance, which is the $20,000 minus the 18,421. 18,421. So this difference minus $20,000. So this difference of 1,579, $1,579, the double entry will be the journal. The journal, we are going to debit the payables to reduce the payables. We are going to debit payables. $1,579, and we are going to credit the profit or loss by the same amount, 1,579. So basically, this is the concept of IAS 21. So we need to know the distinction. If we are going to settle the transaction between the reporting date, then we are going to use the previous analysis, the previous example. But if the transaction is still outstanding at the reporting date, then it means we are going to use this approach to account for the impact of the changes in foreign exchange. So now we are going to move on to the treatment of exchange differences. If the exchange differences relates to trading transactions, very important concept you need to know. If the exchange difference relates to trading transaction, I'm talking about trading transaction, the purchase, the sales, of any transaction that might give rise to the trading, day-to-day trading activities, the purpose of establishment, we can ensure that this is shown in the operating income or operating expenses. It is disclosed within other operating income or operating expenses. If it is a gain, it is other operating income. If it is a loss, it is an operating expenses. For instance, in this situation, it is a gain, then we are going to show it as other operating expenses. Simple. Another aspect, if the exchange differences or if the exchange difference relates to non-trading transaction, it is disclosed within the interest receivable and similar income or finance cost. For instance, if we took out a loan in foreign currency, that is not, a transaction purpose. It's not a transaction. It's not a trading transaction basis. So in that particular situation, we are not going to show the impact, the changes in the exchange rate, whether it's a gain or a loss in the other operating income or operating expenses. Instead, we are going to show it as interest receivable, or we are going to show it as finance cost. Simple. So now let's look at example 3. It's nearly the same from the previous two examples. But let's try to solve it so we can able to understand better. A, B, C as year ended 31st December 20x1. So it means the accounting period starts the 1st of January 20x1 and use it dollar as its functional currency. On the 25th of October 20x1, ABC Co buys goods from the Swedish supplier for the Swedish crown of the SWK of 286,000. The rate of exchange on the 25th of October 20x1, $1 will equals to 11.16. 16th of November 20x1, $1 will equals to 10.87. On 31st of December 20x1, $1 will equals to 11.02. Now I'm not going to solve it again. I'm going to explain. On the live online session, we are going to solve this particular question. The requirement stated that you need to show the accounting treatment for the above transaction if a payment of 286 is made on the 16th of November 20x1. So now, if a payment is made on the 16th of November, it means the payment is made in between the accounting period. So it's simple to do. What we are going to do in this situation, first we are going to establish if there is a foreign transaction, which is yes. Also, if there's any impact of foreign currency, yes, because the transaction date is the 25th of October and the settlement date is the 16th of November. So if this is the case, on initial recognition, we are going to convert the 286 to our dollar, the dollar payment that we are going to make. So when we are going to convert it, we are going to debit the purchase and we are going to credit the payables. Then at the settlement date, also, we are going to convert the 286 using the rate of 10.87, which is the settlement date, the spot rate at the date of transaction. So any difference, will be accounted for as either a gain in other comprehensive income or a loss in the foreign exchange. So this is how you are going to solve the first aspect. The second aspect is the amount owed remains outstanding at the year end. So it means as at 31st of December 20x1, the amount is still outstanding. So at this point in time, we need to identify which one of the transactions relates to monetary and non-monetary transaction. Then for the monetary transaction, we are going to retranslate it at the reporting date using 11.02. So when we are going to do our live online session, we are going to solve this particular example. Very good. So now we are going to look at the monetary transaction, the non-monetary item. Sorry, we have two approach which we can value our non-monetary item. For instance, our property, plant and equipment, our inventory, our building, our intangibles. These are all examples of the non-monetary items within the financial statement. Cost model. Non-monetary items that are held at cost are initially translated at the historic rate and carry forward at this value. They are not retranslated. So for non-monetary item that is carried at cost, for instance, if our property, plant and equipment according to IAS 16 is carried at cost, then it means at the end of the year, we are not going to retranslate any foreign currency transaction relating to the asset relating to the liability. But now, let's assume if the revaluation of fair value model, the non-monetary items that are carried under the revaluation or the fair value model are initially translated as historic rates. When revalued, the fair value will incorporate the exchange rate on the date of revaluation. Gains or loss on exchange are not separately recognized. Very important concept. If you can remember when we covered IAS 16, the property, plant and equipment, to be specific, the fair value, the revaluation aspect. When there is a revaluation, it means already the process of revaluation has incorporated the impact on the exchange rate. So it means if we are going to recognize a gain on revaluation or a loss on revaluation, it has already incorporated the impact of the exchange rate. So there is no need for us to recognize a separate gain or loss on the exchange, as already the revaluation, the fair value model, has already, encapsulate the concept, the impact of the exchange rate. Key points you need to know for the examination. And also, we are going to look at the final point, foreign exchange differences. We have items, we have the exchange rate, we have the gain or loss statement. For monetary items, we are going to translate it using the closing rate, and then the gain or loss should be taken to the profit or loss. For non-monetary item, we are not going to translate it, we are going to maintain it at the historic cost, then there will be no gain or loss. For non-monetary assets at fair value, rate at evaluation, same as the asset, fair value or OCI. For subsidiary translation, now the asset or liability, we are going to translate at the closing rate. Income, we are going to use the average rate. Now, when we are going to look at SBR, consolidation, when we are going to translate, between the parent and the subsidiary, when there is a foreign subsidiary, for the income, we are going to use the average rate. This is the only time that we are going to use the average rate for translate expenses or income. Other than that, asset and liability, we are going to use the closing rate, we are going to use the spot rate. But for income and expenses, we are going to use the average rate. Then the difference will be taken to the OCI, the translation reserve. So finally, we are going to look at the disclosure requirements. Entity must disclose. According to IAS 1, looking at the presentation of financial statement, it is now required to disclose irrelevant information in the financial statement. So it is very much important we understand the disclosure requirements. Functional and presentation currency, we need to disclose it clearly in the notes to account. That the functional currency is dollar and the presentation currency is loans, or dollar and dollar, whichever. The reason for change in the foreign currency need to be stated. Amount of exchange differences, the profit or loss or the OCI need to be shown. The net exchange difference recognized in OCI need to be disclosed separately in the notes to account. So basically, this is all what you need to know about IAS 21. So in our live online session, we are going to look at key questions, very important. For example, question 1, IAS 21, the effect of changes in foreign exchange rate defines the term functional currency. So which of the following is the correct definition of functional currency? We have various options. When we are going to look at when we are going to do the live online session, we are going to solve these questions. Look at question 2 as well, very technical and very important for you to know as a student, and question 3. So basically, that is the end of the IAS 21 session. Thank you very much.